Hello and welcome to a brand new edition of Money, Money, Money. Your favorite personal finance hangout is back. And yes, this will be our date on all things relating with your money, savings and investments every week. I'm Surabhi Upadhyay. The mega consumer tech IPO boom has kicked off and retail investors don't want to miss out on the action. Now, with all the excitement and the hype, it is important to go back to PF and Investing Basics 101, which is why this week on the show, we ask the basic question. How do you evaluate a loss-making internet tech company? And of course, the do's and don'ts to keep in mind while investing in some of the upcoming very high-profile tech IPOs. The guests on the show that will help us do that are Nasir Salim, Managing Partner of Flexi Capital, Ramesh Mantri, Director Investments, Principal Officer at White Oak Capital Management, and Nimesh Kampani of LetsVenture. So let's put some basic numbers on the wall for Zomato. What are the numbers to look at? To start with, revenue, EBITDA, loss. This is what we look at for any company. And here, revenues have been moving higher. The company is still loss-making, by the way, on the EBITDA front and on the net front, the bottom line front. The good news is that losses are reducing. FY20, the EBITDA loss was massive, over 2,300 crores. It's come down to just 467 crores in FY21. Same for the net level. There's still a loss, but it's just about 800 crores. Move over and look at some of the other, and you just heard Nasir use this term, right? Gross order value. This is what analysts are talking about these days. And this, what we do understand is it's increasing. FY20 was a huge pop, then the pandemic, so it's come down to 6,000 odd, but it's still above FY19. So gross order value. Then what else? We just heard, someone talk about contribution. I think Nasir mentioned that point, and the other experts will do that as well. So per order, what we got to know from Zomato is on a per order basis, the company now is making a profit of 20 and a half rupees versus a loss of about 30 rupees last year. Then come a whole lot of other sort of metrics. And look at this. This is what we are talking about. Commissions and other charges. Customer delivery charges. This you and me understand very well, right? It used to be just 15 rupees last year, FY20, actually the year before. And FY21, it's increased to 27 rupees. So that's how much more we're paying for delivery charges. And there are discounts which have gone down, etc. So Nimesh, now you please tell us, which of these numbers are most important for these new age businesses like Zomato? And what are the individual metrics that we now need to start understanding?
So should we just take a step back, right? The way to look at any of these new age technology companies, right? We need to see one of two things in terms of what is the path to profitability, right? And the second one is they should have exponential growth, right? Because today when we look at traditional companies, they are based on earnings multiple, and they already have mature businesses, but since you don't have earnings, right, you need to see very high customer growth, right? And any of these companies, when you look at, and any of the new age technology companies, especially on the consumer tech side, they will be focusing on the principles of user usage and monetize, right? So the first objective is to get as many users as you can, and that's why you will see a lot of losses because your marketing cost, acquisition cost, your cost on discounts and all will be very high. Right? But as you go ahead, and as we had seen itself in the unit economics, right? Once the user becomes sticky and the usage goes up, you can easily tweak some of the numbers. So for example, the delivery charges have gone up, right? Your discounts will go down, your marketing spends will go down. And that is all will actually show you the path to profitability, right? So I think that is one very important metrics that one needs to see. Coming back to how you look at in terms of any of these IPOs coming, right? At a very broad level, I think the usage of funds is one of the most important things that one should look at because these are high growth companies. They offer you growth around 50% a year. How much of the capital is going to go into growth capital, right? In terms of whether are we investing in new products, investing in new services, is it going to be used for acquisition? And that is what I think Zomato has said as well. A certain percentage of the proceeds are going to be used for acquisitions. The new category, the adjacencies, as Ramesh had mentioned. So I think all of those were very important when you are looking at these because they already have 10 million users, right? So 10 million active users, and that is where you can get into the monetization phase. So I think that is one of the big pillars you look at. And some of the metrics that you would definitely want to look at is, the user base, what is present and what can it grow in the future. You will look at some of the customer and marketing matrices, including what is the repeat rate, right? I think that is a very important metrics in terms of how many of a person comes back and uses it, customer acquisition cost, lifetime value of that customer. Because of course you're investing not for one order or one transaction, you're investing for multiple transactions, right? Of course, then you look at your return on ad spend and all of these things. But I think foremost and most important is the usage of funds is what I would definitely look at. Is it growth capital or is it exit to early investors? I think that is one very important thing that you definitely should look at in any of these IPOs.
Whether private equity guys have anyway had the last laugh and whether retail, so to speak, will be left holding the can, or is there still a lot of value on the table? Not just for Zomato, but it's going to be a first of the many more listings ahead.
So I think the way to see, if you look at the private equity guys, right, they've taken the risk at the time when it was a nascent company. It's in very early stages of growth. So of course, the risk little metrics will be very different, right? And I think today where we are, any of these companies which are doing an IPO, if I were to look at, give an analogy on cricket, it would be the second day of the test match, right? We still have a long runway to go. There is a huge growth potential available in a country like India. So I think it's not that you'll be holding the baby, but I think the way to look at it is that you need to be a lot more patient, right? Because this is not a one-year game that you will get money on listing or you'll make money in a year. I think when you're investing in any of these companies, you have to invest for 3 to 5 years. Just the way a private equity guy invests, right? It's not a short-term bet that you are taking on the markets.
And one final, most important question: the mistakes to avoid, how to ensure not to get burned, and the topmost thing to keep in mind as this IPO gold rush of technology companies, hits the Lal Street. Nimesh, you go first.
So I think patience will be the key. So I think if you have capital which you want to keep aside for, say, a 5-year period, I think that's the only way you can look at these segments. Definitely, you should have some allocation to this space. But of course, you have to differentiate between the wheat and the chaff, and each IPO will be different as it comes.